Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Invesco's strategic ETF 100 zero portfolio. And that simply refers to that the portfolio is allocated 100% to equities and has no fixed income or alternatives allocation. If we do look at the underlying holdings of this portfolio, it's nice to see that this is not exclusively comprised of Invesco ETFs, because typically you see in BlackRock's model portfolio only iShares ETFs, but in this case, actually, we do see products from State Street, from Vanguard, and even from JP Morgan. Now, the three largest allocations in this model portfolio is, Russell 1000 Dynamic Multi-Factor ETF with 20% weight. We have a NASDAQ one with 14% and S&P 500 with 14%. If we look at the benchmark that is automatically suggested, it is the FTSE Global All Cap Index. In this case, I'm going to use the MSCI World Index, which is very similar. And effectively, this is a global equities portfolio, providing exposure to US and international stocks. If you look at this from a fee perspective, we can see this portfolio is relatively cheap at 17 basis points. And we can also see the performance versus MSCI World. And so since 2022, the performance of this portfolio would have lagged the MSCI World, although the underperformance only started about a year back. Now, it is worth mentioning that we're analyzing the current portfolio and not the entire track record of this portfolio. Having said that, we can simply have a look at the fact sheet of this model portfolio. And what we see over here, we see the kind of like pure gross return, which since inception in 2017 was 9.13% versus the benchmark that Invesco has chosen was 9.79%. Stated differently, this portfolio has underperformed its benchmark by around, 60 basis points or something like that, which is not that great. Moving on to comparing this portfolio in terms of how different is this to the MSCI World Index, we can have a quick look at the asset classes. Now, what we observe over here is effectively that this is, as mentioned, an all equities portfolio, right? There's no fixed income, real estate, commodities. We can see from a breakdown by markets that the portfolio is slightly underweight the US, but only slightly, right? 67 versus 70%. There is a larger difference in the average market capitalization, which is 74% for Invesco's portfolio versus 88% for the MSCI World. And we can see similar minor differences in terms of breakdown by top 10 countries. We can also change the perspective to sectors. But here, surprisingly, we see very little difference to the MSCI World. We do see that, yes, sure, there's slight underweight in tech, right, or healthcare, slight overweight in consumer discretionary, but these portfolios from a sectoral perspective are almost identical. If we change the perspective from sectors to factors, we can look at the equity factors and asset class factors from a returns-based factor exposure analysis. We do see it's an all equities portfolio. And from an equity factor perspective, we do see that there's been a almost consistently positive exposure to the value factor, to the size factor, and to momentum, while negative exposure to low volatility quality. And we can explain that simply via the holdings. So we do see, of course, the S&P 500 value ETF in here. We see a little bit of small cap exposure here, ex-US, also small mid cap again, ex-US, which explains the exposure to the size factor, positive one, right? And there's this multi-factor product in here as well. Having said that, the problem a little bit is that the betas to those equity factors are very low, and that effectively leads that almost all of the risk is explained by the stock market. Equity factors contribute almost nothing. And unfortunately, we see here what we see in many products, that there's too many funds that have factor exposures that offset each other. So for example, we can see the largest allocation, which is the Russell 1000 Dynamic Multi-Factor ETF, has a negative beta to the value factor. But then we have the S&P 500 Value ETF, which has a positive beta. And positive, negative plus positive, like it just nets itself off. So this is a portfolio that is not so sensibly constructed. We can also ask whether we can reduce the fees of this portfolio. And so for every fund over here, we can see, is there a cheaper equivalent? So for example, there's this international developed fund, which is charging 34 basis points. And we could replace that one, like similar exposure from Neuberger Berman, that is only charging 7 basis points. And if we basically replace every single fund in this portfolio with a cheaper one, we can reduce the cost from 70 basis points to 6 basis points, and that actually would have improved the performance. So what's not to like? Finally, we can ask the question whether we can simplify this portfolio, and short answer is yes. So here we have a simplification that, simply suggests the Vanguard Total World Stock Index, right? And you can see the simplified portfolio, right, is charging 7 basis points versus 17 for this portfolio comprised of 11 securities, right? And the Sharpe ratio would have been higher, right? Return would have been higher, and volatility would have been slightly higher, but you get additional returns for that. So this kind of summarizes our portfolio review of Invesco Strategic ETF 100 portfolio, which provides exposure to global equities. It's cheap at 17 basis points, but it can always be made even cheaper. And as we can see, there's no need to have 11 securities that have conflicting factor exposures. You can simply replace this portfolio with a one security, right, with an ETF from Vanguard, right, which dramatically simplifies that. Hope that helps. Have a nice day.